Alright, moving on to 16.4. We're going to record closing entries for income statement accounts. We prepared closing entries back when we did Delgado Web Services too, so that was back in Chapter 8. First of all, closing entries. Closing entries for a corporation are made from information in the adjusted trial balance. A corporation records 4 closing entries. First of all, a closing entry for income statement accounts with credit balances, revenue and contra cost accounts, and then a closing entry for income statement accounts with debit balances, and those are the cost, contra revenue, and expense accounts. Thirdly, a closing entry to record net income or net loss in the retained earnings account, and close the income summary account that we're going to talk about for a while. And then lastly, a closing entry for the dividends account. Okay, the income summary account. At the end of a fiscal period, the temporary accounts are closed to prepare the general ledger for the next fiscal period. To close a temporary account, an amount equal to its balance is recorded on the side opposite the balance. Amounts needed for the closing entries are obtained from the adjusted trial balance and from the statement of stockholders' equity. The closing entries are recorded in the general journal. If you remember back with Delgado Web Services, we talked about permanent accounts and temporary accounts. Permanent accounts were the easy ones. They're real. They include the asset and liability accounts as well as the owner capital accounts. I think of those as more of tangible things you can touch, like assets. The ending account balances of permanent account for one fiscal period are the beginning account balances for the next fiscal period. The temporary accounts are harder. They're nominal accounts, including the revenue, cost, expense, and dividends accounts. Another temporary account is used to summarize the closing entries for revenue, cost, and expenses. The income summary. It's used to summarize information about net income. The income summary is used only at the end of a fiscal period to help prepare other accounts for a new fiscal period. If you remember, income summary account is unique because it does not have a normal balance side. The balance of this account is determined by the amounts posted to the account at the end of a fiscal period. When revenue is greater than total expenses, resulting in a net income, the income summary account has a credit balance as shown in the T account. So revenue greater than expense, credit balance is the net income. Okay, and I think we always had to make ourselves a note of that when we were working with Delgado Web Services back in Chapter 8. Okay, moving on. Closing entry for accounts with credit balances. 3 Green's adjusted trial balance has 4 income statement accounts with credit balances. One account, sales, is a revenue account. 2 accounts, purchases, discount, and purchases, returns, and allowances, are the contra cost accounts. On this slide here, we're just dealing with sales and interest expense. And the next few slides, we're going to do purchases, discount, and purchases, returns, and allowances. The 4th account is the other revenue account. Each account has a normal credit balance and must be reduced to 0 to prepare the account for the next fiscal period. To reduce each balance to 0, each account is debited for the amount of the balance. The impact of the closing entry on sales is shown in the T account. Okay, here's our impact on sales. Okay, the balance was $632,000, so we need to debit it over here. Okay, the next one is income summary, $635,000. So we need to total amounts. The balance of income summary will be adjusted by other closing entries. Okay, so first we're going to write closing entries. closing entry is in the middle of the General Journal's account title column on the new page. This heading explains all of the closing entries that follow, therefore indicating a source document is unnecessary. The first closing entry is recorded on the first 4 lines below the heading. Write the date in the date column, and then write the account title of each revenue and contra cost account in the account title column. Write the balance of each revenue and contra cost account in the debit column. So we have debits to close: sales, purchases discount, purchases returns and allowances, and interest income. Okay, and all of these credit amounts go in the debit column here because we're closing it out, so it has to equal 0. So $632,000, $992, $1495, and $557. Add all of those up, and it goes right there. Write the title of the account credited income summary in the account title column, indented about 1 centimeter. Write the amount of that total in the credit column. All right, closing entry for income statement accounts with debit balances. 3 Green's adjusted trial balance has many income statement accounts with debit balances: contra revenue accounts, purchases, and the expense accounts. These debit balances must be reduced to 0 to prepare the accounts for the next fiscal period. To reduce the balances to 0, the accounts are credited for the amount of their balances. Income summary is debited for the total amount. So first we're going to write the date, and then the title column account or income summary. The debit to income summary is not entered in the amount column until all contra revenue, cost, and expense balances have been journalized and the total amount calculated. Write the account title of each contra revenue, cost, and expense account in the title column, each indented about 1 centimeter. Write the balance of each account in the credit column. So here we have sales, sales revenue and allowances, purchases, advertising, credit card, utility, and federal income tax. So all of these debits go in the credit column over here, including the ones that are in this little white line. So all of these get written down, and we're closing them out so they get credited. Add the credit amounts for this entry. Write the total of the credited accounts in the debit column on the same line as the account title income summary. So we added all these up and we wrote it up here, sort of backwards, but it's okay. Okay, the second closing entry reduces the balance of contra revenue purchases and expense accounts to a 0 balance. The effect of the closing entry on purchases is shown in the T account. So our balance is on the debit side, so we have to credit it to get a 0. After recording this closing entry, income summary has 3 amounts. We have a debit of $5,643, the amount of the merchandise inventory adjustment, a credit of $635,345.90, the amount of the entry to close the revenue and contra cost accounts, and then thirdly, a debit of $549,889, the amount of the entry to close the contra revenue, cost, and expense accounts. So we're going to have to account for all of those. The credit balance of income summary, $79,000, right here, $79,896.57 is equal to the net income after federal income tax amount shown on the income statement. However, income summary is not closed as part of this closing entry. Instead, the account is closed with the third closing entry when the net income is recorded. Phew! So after closing entries for the income statement accounts are posted, income summary has a credit balance of $79,000. Where are we? Income summary has a credit balance of $79,896.57. This credit balance equals the net income reported on the statement of stockholders' equity and income statement. A corporation's net income should be recorded in the retained earnings. Here we have retained earnings account at the end of the fiscal year. After the closing entry is posted, income summary has a zero balance. So we close it to retained earnings right here and gives us a zero balance of the income summary. The new balance in retained earnings does not yet equal the amount reported on the statement of stockholders' equity. A fourth closing entry is required to adjust retained earnings to the correct amount. Right there. All right. So we have a date, our income summary with the $79,000 that we have to debit to make a zero balance, and all of that goes into the retained earnings to show how much the company made during that fiscal period. Closing entry for dividends. Because dividends decrease the earnings retained by a corporation, the dividends account is closed to retained earnings. After the closing entry is posted, dividends has a zero balance. The amount of dividends account, $15,000, has reduced the balance of retained earnings. The new balance in retained earnings, $130,115.41, now equals the amount reported on the statement of stockholders' equity. Therefore, the retained earnings account is up to date. So we're going to write the date. Our retained earnings of $15,000 is debited, and that goes into credit dividends. So retained earnings is increasing. All right, all of that is our completed closing entries for a corporation recorded in a journal. We started out with sales, and then we did our income summary with all of those things, and then we're zeroing out our income summary into retained earnings, and then our dividends go into retained earnings also. Phew! Where is the information obtained to journalize closing entries for revenue, cost, and expenses? Our adjusted trial balance. What is the name of the temporary account used to summarize the closing entries for revenue, cost, and expenses? Income summary. I remember when we did it in Chapter 8. It was a bit confusing, but we got it by the end. Oh, and that's it.